There's two ways out of this, as a banker. You can have an honest default, which is to say the U.S. government tells the bondholders, too bad, so sad, no money, strong letter to follow. And they tell old folks like me, yeah, right, you paid into Social Security for 60 years, but that doesn't matter. You can't have any money. I don't think that's what we do. I think what we do is we reduce the purchasing power of our obligation and have a dishonest default. At the same time, in New Zealand popular culture brought in a Labour politician, Roger Douglas, who, unlike many of his fellow countrymen, could add and subtract. He looked at the budget in New Zealand, he looked at the economy and said, what I'm saying today, the math doesn't math. And I think it was probably only a Labour politician in New Zealand that could have accomplished what Roger Douglas did. I had the good fortune to spend some time with him. And while it pains me to say I admire any politician ever, I admired Roger Douglas. They say with regards to Japan, it doesn't matter because the Japanese own their own debt. That's not true. The Japanese say we owe it to ourselves. By the way, that's become an increasingly common phrase in the United States. But that's not true. The spenders owe it to the savers. Unfortunately, in democracy, there's always more spenders than there are savers. In the decade of the 70s, in addition to the fact that people lost 75% of the purchasing power that they enjoyed with the bond, they also lost principal. A 30-year U.S. Treasury bought in 1980 with an interest yield of 5.5%, lost 65% of its principal value in the decade 1970 to 1980. A truly, truly, truly ugly circumstance for people who chose to invest in what they perceived as a risk-free instrument. I'm glad you mentioned that. You said a couple things there as a banker, which ought to be unpacked. First of all, a time spread has killed more banks than any other form of stupidity. A time spread is taking advantage of the interest rate curve by lending long and funding it short. When the interest rate rises, the capitalized value of your bond holdings or mortgages falls at the same time that your cost to fund them increases. That's what brought down the U.S. savings and loan industry. It's what brought down Silicon Valley Bank. Why these morons keep doing it is beyond me. Bank of America, as an example in the U.S., have, and I don't know the exact number, but numbers like $100 billion in unrealized losses in their balance sheet because of what the Fed calls mark to market and what some of us bankers call mark to myth. If you're Brazil and you're running a big operating deficit, you're liquid because you have some gold, but you're not solvent. When your liquidity runs out and you're still insolvent, then you have no gold to settle with. What we saw 4 or 5 weeks ago, 3 weeks ago, for people who were lucky enough to have early expiring contracts, is that people who took good delivery in Chicago could put it on a plane, send that silver to London and make 4% overnight, which is, it's pretty attractive. And that did, let's just say it caused some ripples in the North American silver market, not anywhere near the ripples that existed in the London market, which was basically empty.
I'm your host, Farzin Irani. Let's connect the dots. Our guest today is the one and only Rick Rule, one of the world's most trusted voices on precious metals and natural resources. Welcome, Rick. It's such a pleasure to have you on our show.
Pleasure to be with you, Farzin. I look forward to the process.
Yeah, thank you. Generally, the way we start these conversations, Rick, is we just say, in your own words, could you tell us a bit about your background and how you got started in the financial and investment markets?
Well, I should start by saying I'm an old guy now. I'm 72. I've been lucky in that I wanted to start off my life in natural resources, so I've been involved in effectively the same business for over 50 years. I learned enough about conventional financial services as they related to natural resources that I became conversant in conventional financial services too, which is to say things like insurance, wealth management, asset management, and banking. So I've been employed in financial markets around natural resources and conventional financial services since the very early part of the decade of the 1970s. I've had the extraordinary good fortune of meeting a lot of people when I was young who went on to become extremely successful uh, natural resource entrepreneurs. The Lundin family, Robert Friedland in Australia, Robert de Crepney, Owen Haggerty, and I have been able in my own way to help finance them when they were starting out. And the consequence of that is that they have brought me along as they matured. I once said at a conference, part of my success was know-how, but a whole bunch of it was know-who. The idea that you're part of the inception of these great entrepreneurs, the Ross Beatties, the Bob Quartermains, from Australia, Stephen Dean, that's been wonderful. And because I was involved in all aspects of resources, but particularly finance, as a consequence of in the last 50 years, I learned a lot about conventional financial services too. I've been an integral part now of 7 banks, Battle Bank being my latest. I was our prior bank, Everbank, came to being on my living room floor. We built that from zero to $28 billion in AUM with 275,000 customers. In natural resources, my greatest financial services success was obviously Sprott, which has grown from 2 billion AUM when I joined to 50 billion AUM today, again, serving 300,000 customers worldwide. So it's been a very, very, very pleasant life for me, Farzin. I would caution you that if you ask me too many questions outside what I know, if you were to ask me questions about, technology or retail or consumer durables, I would just have to smile and say, I don't know. But I've been fortunate enough to develop a fairly deep knowledge in conventional financial services and natural resources. I'm also, by now, very active philanthropically, uh, particularly around free market economics, which is to say, organizations that empower the individual rather than the governments, things like Students for Liberty and the Atlas Foundation. And I'm very active philanthropically in economic empowerment for extremely poor people, mostly via microcredit and mostly, perhaps of interest to you, in South Asia, Bangladesh, India,
Yes.
Pakistan, and Sri Lanka.
Yeah. Yeah. Hey, thanks. That was honestly, you've had such a, an interesting career. And I remember when I used to listen to you on podcasts and people were like, oh, you said you were getting close to retirement. And I was like, no, not Rick, hopefully not. And then obviously you started Rule Investment Media as well. So I think you didn't want to retire
I
after
failed
all.
retirement completely. I even failed the idea of it. My wife would tell you, jokingly, that my mind needs to be stimulated or sedated, and that working is healthier for me than drinking. And so, perhaps out of self-defense, I kept working. But I think an entrepreneur is built around identifying a market that needs to be served and finding a way to serve it. That's how entrepreneurs get their sense of well-being, and I'm certainly guilty of that.
Just to start things off, right? So I believe this is going to be quite an interesting period, and people are going to write books about the times we live in. And before we dive into the details, what's your big picture view or macro thesis about the times we're living in, and how do you see things playing out over the next 3 to 5 years?
Well, I need to say that despite what will follow in this interview, I'm a long-term optimist. I believe in the human spirit. I believe in the march of technology. I'm delighted that with the internet and distributed learning, that the economic success through technology that the United States enjoyed is going to spread worldwide. My optimism has always been founded as a consequence of being born and growing up in Silicon Valley in San Jose, and seeing this extraordinary culture where 5 or 6 youngsters could take over a garage in Sunnyvale, and out popped Google or out popped Apple. What excites me now is because of the distribution of education, distance learning, the internet, connectivity, this garage doesn't have to be in Silicon Valley anymore. It could be in Bangalore. It could be in Sao Paulo. The idea that the responsibility for success no longer rests on 300 million people, but rather 8.3 billion people is extremely exciting. That's the good news. The bad news is that although for 50 or 60 years, our individual creativity and tenacity has funded our collective stupidity, that is to say, the way we build, the way we vote, I think we're pushing on a string. I can't talk to either New Zealand or India. I'll leave it to you to do that. But in the United States, the arithmetic, Farzin, is getting challenged. You're no banker, so you'll understand what I say by this.
Yes.
The on-balance sheet liabilities of the U.S. government now exceed $38 trillion. I emphasize that because people's eyes glaze over. They don't like to think about a number that size. They can't comprehend it. But 38T, that's 12 zeros, right? More scary, not more scary, terrifying. And nobody thinks about this. The off-balance sheet liabilities of the U.S. government, Medicare, Social Security, federal pensions, military pensions, hugely popular programs. The net present value, not nominal value, of those liabilities are $120 trillion. Now, if you add those two numbers together, and it's unfair to add them together, because let's take the on-balance sheet liabilities down to 31 trillion, because the Fed's balance sheet is 7 trillion. So let's say 30 trillion, knock a trillion off, and 120 trillion on off balance sheet. That's $150 trillion in liabilities at the federal government level alone. The Internal Revenue Service's estimate of the entire private net worth of Americans is $167 trillion. So you as a banker are looking at a client with a net worth of $167 trillion and liabilities with a net present value of 130 trillion. It gets a little worse because the income of the debtor, the gross income of the U.S. government before they spend a dime on anything, is $5 trillion. The on-balance sheet deficit increases by $2 trillion a year, and the off-balance sheet liabilities increase by $2 trillion a year. So the debtor's income is $5 trillion, and their operating deficit is $4 trillion, and they have to find a way to honor $150 trillion in net obligations. I'll make it easy for your audience. The math does not math.
Farzin.
There's two ways out of this, as a banker. You can have an honest default, which is to say the U.S. government tells the bondholders, too bad, so sad, no money, strong letter to follow. And they tell old folks like me, yeah, right, you paid into Social Security for 60 years, but that doesn't matter. You can't have any money. I don't think that's what we do. I think what we do is we reduce the purchasing power of our obligation and have a dishonest default. In other words, we honor the obligation, if that's the right phrase, with increasingly devalued currency. We did this before, Farzin, before most of your audience was born, in the decade of the 1970s. according to the Congressional Budget Office, the purchasing power of the U.S. dollar in the period 1970 to 1980 declined by 75%. I think past is prologue. I think the next 10 years we'll see the purchasing power, the absolute purchasing power, not relative, the absolute purchasing power of the U.S. dollar decline by at least 75%. I'm not talking about the U.S. dollar relative to the Australian dollar or the New Zealand dollar or the euro or the pound, but rather the absolute purchasing power. I see the U.S. dollar being roughly competitive with other currencies, but I see absolute decline in the purchasing power of the U.S. dollar mirroring that in the 1970s. The logical consequence of that is that if you view the decade of the 70s, the gold price, gold being a commodity that has historically done well when people are concerned about the maintenance of their purchasing power, the gold price in the decade of the 70s increased 30-fold. I'm not suggesting to you the gold price is going to increase 30-fold. It's already increased 12-fold since the year 2000. But it wouldn't surprise me to see the nominal U.S. dollar quoted gold price increase by a measure that reflects the deterioration of the purchasing power of the U.S. dollar. So a threefold increase in 10 years seems not merely possible, but probable to me.
Yeah. Thanks for that big thesis. You've covered quite a few things that I aim to discuss with you today. Obviously, the bonds, the interest rate, the financial repression that's coming, and obviously everything else that comes in between those, right? So obviously I wasn't born I was born in 1978, so I wasn't born when the big inflation came about. But my audience is the older generation as well, so they do understand what you're saying. But you talked about the US example, right? The one thing that I'm looking at is back in the 1970s, the US debt. When Paul Volcker, obviously there was a lot of inflation, and the Federal Reserve Chairman at the time obviously increased interest rates to fight inflation. I think it went up to 18 or 20. And in New Zealand, I've had a few people tell me it had gone up to at least about 15% out there as well. But in US's case, in that time, the US debt to GDP was about 34 point something percent. I think it was 4.7. So they could do it. They could increase interest rates to fight inflation. And as to your point, we've just crossed $38 trillion of US debt, which is about 120% of debt to GDP. So are you recommending that the US government, obviously you've already said it, you're not recommending, but you think the US government is going to do financial repression by stealing people's future money or buying power, as you said it?
Is that financial repression? I don't know. I think, unfortunately, all of the wrong programs are extremely popular politically. H.L. Mencken once said that the voter almost always gets what he or she wants, usually good and hard. I think, despite the fact that we have a relatively strong economy in the U.S., they're going to lower interest rates. That will signal to savers and investors around the world that the U.S. society doesn't care about the sanctity of the U.S. dollar. It's interesting you bring up Paul Volcker. We had an election in 1980 in the United States, and there was a popular mandate across the country to reduce the size of government. Ronald Reagan came in with that mandate, and within 6 months of his inauguration, he had been effectively emasculated by Congress. He was able to slow the growth of the U.S. government, which turned out to be enough. But the first 2 years were extremely painful. He allowed Paul Volcker to let the market take control of interest rates. Paul Volcker didn't raise the interest rate. He got out of the way. And we had a situation where inflation was 15 or 16%, and savers demanded a 2% or 3% real yield above the rate of inflation. So it was the market itself that took the inflation rate to 18, 19, 20. And that was really, really, really a hard time. You can imagine yourself if the Fed funds rate is 16 and the prime rate is 18.5. That means the first mortgage rate is 19. That was a really interesting time. But within 2 years, they broke the back of inflationary expectation. They handled the deterioration of the US dollar. And as a consequence of, while they didn't cut government expenditures, they reduced the rate of government growth. When the period of lower interest rates commenced in 1982, that kicked off a 12 or 14-year period where the U.S. economy grew at an absolutely breakneck pace. And they were able to enjoy spectacular economic growth. Unfortunately, they didn't use that period to reduce debt. You might remember that the Republican administrations at that time coined a phrase that says the deficit doesn't matter, which is what we're finding out today. At the same time, in New Zealand popular culture brought in a Labour politician, Roger Douglas, who, unlike many of his fellow countrymen, could add and subtract. He looked at the budget in New Zealand, he looked at the economy and said, what I'm saying today, the math doesn't math. And I think it was probably only a Labour politician in New Zealand that could have accomplished what Roger Douglas did. I had the good fortune to spend some time with him. And while it pains me to say I admire any politician ever, I admired Roger Douglas. He was...
You're not going to be popular for saying that.
In particular because he came to the right policy conclusions from the left, which is not what I would have expected. But, clearly he was a kind-hearted human and wanted well for his country.
Hi guys, if you're getting value from what I share, please take a second to like this video and hit subscribe. It helps get these ideas in front of more people who need clarity in a noisy world. And if you know someone who would benefit, share it with them. Your support grows this community and keeps me creating content that makes a real difference. Thank you for being part of the journey and keep connecting the dots. Don't you think politics has changed quite a lot? Okay, let's probably not go into politics, because I think the politicians we get nowadays, and I've openly said this when I get interviewed and on these podcasts as well, I think some of our politicians are just brain dead because they can't work out 2 + 2 = 4, and they just think this gravy train is going to last forever. If we run our households like the way governments run the country, I think we'd end up in jail or we'd be broke by now, right? So, because first of all, they counterfeit money, the central banks and the governments in cahoots, and then they expect us to pay taxes for money that can be created out of thin air. Any thoughts on that?
Well, you can go further back to your career as a banker. Would you, if the U.S. government didn't have battleships and nuclear bombs, if they didn't have the ability to counterfeit money and pay you back, would you lend them money? If they have $150 trillion in liability against $167 trillion in assets, where their debt is growing by $4 trillion a year, and their income is only $5 trillion a year before their expenses, I mean, there's just no way you would do it. This is just simple arithmetic.
It's a trick. It's an accounting trick that they're playing, and I think I've mentioned it quite a few times as well. I don't know about the New Zealand government because before I was born or younger, but as I've said, most governments never, ever end up paying off their debt. They just have to roll over the debt and make sure that the government or a superannuation fund or somebody else out there is going to buy their debt and can be rolled over, because they never, ever pay it back. And the problem, as I've already told my audiences, and when I get interviewed on Money Talks, for 2 years, I have told them there could be sovereign defaults coming. Now, you said maybe America doesn't default in the normal fashion, but I actually think Europe and Japan, those are the two problem areas where we might actually have a sovereign default incoming. Your thoughts on that?
Yeah, they say with regards to Japan, it doesn't matter because the Japanese own their own debt. That's not true. The Japanese say we owe it to ourselves. By the way, that's become an increasingly common phrase in the United States. But that's not true. The spenders owe it to the savers. Unfortunately, in democracy, there's always more spenders than there are savers. we have a little animal in the United States called a coyote, cute little thing, but they eat everything they get near. And there's a joke in the United States that an election is the process by which 4 coyotes and a lamb vote on the lunch menu. Clearly, the coyotes are spenders and the lamb is a saver. And if you have 4 spenders and 1 saver, and they're voting on what the lunch menu is, the choice is fairly clear. And I think that's the circumstance that you've seen in New Zealand, and it's certainly the circumstance that you see in the U.S.
Yeah, I think it's a global issue that we have on our hands right now, obviously. So you mentioned about the government debt and stuff as well, and you said they want to reduce interest rates, and you think the Federal Reserve has dropped interest rates recently. They were quite resistant compared to some European countries and New Zealand, Australia, everywhere pretty much, even in India. Um, what impact do you think that's happening? Because obviously there's the butting of heads going on between Trump and the central bank. The central bank, they say, is independent, but the president who loves debt, any president, in fact, I brought it up on the show before. In the US, I think the debt doubles every 8 years, regardless of whether it's a Democratic president or a Republican president. So if the debt's going to keep going up and the Reserve Bank or the Federal Reserve is going to keep dropping interest rates, what do you think is happening to the long-term bonds?
I remember, I think it was Franz Pick that described the long-term bond as a certificate of guaranteed confiscation. The idea that you would own a maturity longer than 5 years, I don't own a maturity longer than 2 years, but the idea that you would own a maturity longer than 5 years at what I think is a negative real interest rate is crazy. I mean, let me explain to your audience um, my concept of negative real interest rates. If you, and I'm sorry this is so US centric, but I'm not as familiar with the New Zealand circumstance as I was when I lived.
No, but they'll get it.
Um, in the US, we publish this thing called the CPI, the Consumer Price Index. It's not a cost of living index, it's an artificial index. If you believe the CPI, you suggest that American inflation is trotting along at 2.9%. Not attractive, but not catastrophic. And if you believe that 2.9% number, then you think the interest on the 10-year Treasury, 4.5, is okay. You're making 4.5 in a currency that's declining by 2.9 a year. So you're making 1.1, 1.2% positive yield. The problem is that the CPI should be referred to as the CPI. It's a joke. When it's inconvenient, it doesn't include food or fuel. If you took a full body shot of me right now, you could see that lunch is important to me. An index that doesn't include lunch is of no interest to me whatsoever. And the index has what they call hedonic adjustments, which is to say they measure the utility that they see in an item rather than its price. And laughably, the consumer price index doesn't include tax, the largest household expense of most Americans. I believe that the deterioration of the US dollar is proceeding along at a number closer to 8 than 2.9. And now the long bond comes clear. A 10-year bond pays you 4.5 in a currency that's declining by 8, which means that you're losing 3.5% of your purchasing power every year for 10 years. In other words, the U.S. government solemnly swears that if you give them $100,000, they will give you back $60,000 in purchasing power in 10 years. But of course, it gets worse. My belief is that the rate of deterioration of the U.S. dollar, which is a different way of saying inflation, will increase as opposed to decrease. That means that the capitalized value of your distribution from a bond, your interest payment, becomes worth less and less on a net present value basis. In the decade of the 70s, in addition to the fact that people lost 75% of the purchasing power that they enjoyed with the bond, they also lost principal. A 30-year U.S. Treasury bought in 1980 with an interest yield of 5.5%, lost 65% of its principal value in the decade 1970 to 1980. A truly, truly, truly ugly circumstance for people who chose to invest in what they perceived as a risk-free instrument.
The risk-free return, or the safest asset in the world, the U.S. Long bond, so to speak. But didn't that also happen during 2022, where that was a quick moment, obviously, in 2022, because after COVID, when they started increasing interest rates. And that was one of the reasons where, obviously, there were other reasons why some of the banks went under in the US. But obviously, a lot of the banks' balance sheets are kind of upside down because the Federal Reserve came out with this BTFP and said they don't need them to market. That is another game that's being played behind the scenes.
I'm glad you mentioned that. You said a couple things there as a banker, which ought to be unpacked. First of all, the time spread has killed more banks than any other form of stupidity. A time spread is taking advantage of the interest rate curve by lending long and funding it short. When the interest rate rises, the capitalized value of your bond holdings or mortgages falls at the same time that your cost to fund them increases. That's what brought down the U.S. savings and loan industry. It's what brought down Silicon Valley Bank. Why these morons keep doing it is beyond me. It's a pretty good business. The second thing that you talk about is the so-called mark-to-market. In banking in the U.S., we call that mark-to-myth. The way it works is this. If you have a portfolio of long-term debt securities on your balance sheet, you are allowed to say to the Fed, these are not trading positions. We're going to hold them to maturity. And as a consequence of that, you get to use the 30-year default rate, the long-term default rate, as a way to risk your portfolio. So you own a bond that's a 25-year bond. Let's say some great credit like Greece or India. And this bond is trading at the market at 60. Okay, that's what the market is paying for the bond. But you tell the Fed, well, it's not for sale. I'm holding it for 10 years. They allow you to mark that bond in your portfolio at par rather than at market because they say it's not a trading position. So some of the great big banks, Bank of America, as an example in the U.S., have, and I don't know the exact number, but numbers like $100 billion in unrealized losses in their balance sheet because of what the Fed calls mark-to-market and what some of us bankers call mark-to-myth.
So when you say Fed, obviously, I just want to ask you this. I've asked some of my other guests as well. Do you see central banks as arsonists or firefighters?
Well, I need to say, with regards to the U.S. Fed, I know by now, starting a bank, a few of the local people in the Fed. And at the lower levels, it's actually a pretty honest institution. The institutional bias within the Fed is that they're the only arm of the U.S. government that has any interest in the sanctity of the U.S. dollar. And the policy by which they lower interest rates is, in my experience, anecdotally, universally unpopular among lifetime Fed employees. But at the top, it's pretty politicized. And I think that they don't have the political will to tip us into a reckoning, to tip us into a recession, which is what they did in 1980, 1981, and 1982. The penalty that we paid for the reckoning was high, and we need to pay it again. To describe them as arsonists, I guess if I was going to be, I'll use the phrase, I can't resist it, inflammatory. I think I would regard them as co-conspirators with the executive branch, with the legislative branch, and sadly, with the length and breadth of the American voting population. Postponing a reckoning, postponing the circumstance where our society is caused to live within its means, is extremely popular with voters. Every voter has a cause which is near and dear to their hearts, and believe gives them a call on future generations' prosperity. Everybody. One person's fraud and abuse is another person's necessary service. So castigating merely the Fed, merely the president, merely Congress, without looking at oneself in the mirror is dishonest and I think self-defeating.
I'll just share a quick view on what I thought after the global financial crisis. From a European perspective, Europe, Japan, Switzerland all went to negative interest rates, obviously, because they thought by just lowering interest rates, we will get people to borrow more. But the whole thing is they don't realize that the individual family is trying to repair their balance sheet because they're over indebted and they just have too much debt. So in spite of negative interest rates, people did not go out and borrow more. Well, the majority did not. In fact, I heard in Japan, the maximum amount of safes were sold during that time because people were withdrawing cash from their ATMs and actually holding cash at home in the safes, right? But let's say, for example, with what's happening now, most of the central banks started reducing interest rates. The Federal Reserve did not, because obviously, yes, the US dollar is the global reserve currency and the economy was doing quite well. So there was no need for them to reduce interest rates. And they actually got in trouble just not that long back when they said it's transitory and they raised it a little bit too late. So they know they got themselves into trouble. So they didn't want to drop it off too quickly. But the reason I'm asking you, have they been politicized now? Because inflation's not really gone away, if I'm being honest. The economy is slowing down. Do they see a recession? I think a recession in America has already started, even though the numbers are not necessarily telling you that. But do you think if inflation's still biting at people's budgets, their weekly budgets or their monthly budgets, and they can't afford food and groceries, and if we go into a global war, that's going to be even more inflationary, should they be dropping interest rates, or is this just too much political pressure? Cause the government's in so much debt.
Of course, they shouldn't be dropping interest rates. The government should have nothing to do with interest rates. They should also not be engaging in quantitative easing, which is to say printing. If you were engaged in that process, Farzin, they would call it counterfeiting and you would be put in prison. If Congress does it, it's highly popular and they get reelected. When I need to take issue too with what you inferred around inflation. I don't think inflation is tame at all. I think the difference between their stated rate of inflation, 2.9, and the real rate of inflation is incredible. And I think Americans are starting to notice it in the sense that grocery prices are now a political issue. Healthcare and health insurance is now a political issue. Gasoline and energy prices are a political issue. Americans feel the impact of inflation on their budgets, but right now they believe their government. They don't believe there's inflation, despite the fact that their grocery bill is double, their health insurance bill is double, their rent is double, their mortgage payment is double, and this is in only 5 years. It's an odd circumstance. Oh, and by the way, their tax bill's gone crazy. It's very odd, this dichotomy in belief, and it actually reminds me of what I've studied about the decade of the 60s, when U.S. inflation was fairly high, although U.S. inflation rates, published rates were fairly low. It really took until 1972, the period of 1968 to 1972, there was a 5-year period where the U.S. public experienced inflation, but didn't understand that inflation was the cause of their duress. And I think we're in that same period right now.
Okay. So you think people will eventually wake up? Because I thought the whole inflation was one of the reasons why Trump got elected, because Biden kept saying it's Putin's inflation and he blamed Putin for the inflation.
There are 72 million voters who think that inflation under Trump isn't a bad thing.
Okay.
Their guy is the
Okay, so
author.
inflation under Trump is not a bad thing, but inflation under Biden was a bad thing. Yeah, fair enough. Because it's my guy. Okay.
There's a wonderful Mencken saying that says you can tell a politician is lying when their lips are moving. It would appear that some voters prefer to be lied to from their own side. And that applies equally to Democrats and Republicans in the U.S.
Absolutely. Absolutely. I think most Western governments are in this they've got themselves into this corner where they make promises they're not going to be able to keep. As I keep saying, we kind of lucky in, because I was raised in India, but I have spent the last 25 years in New Zealand and Australia. And I keep telling my audience as well, we're kind of used to the whole fact that, oh, you've got free healthcare and free education and all of that. And now people can see through the facade is the government has to keep borrowing. And as the government keeps getting broke,
Right.
it's in trouble. But while we're on that topic, I want to ask you something that I've asked a couple of my other guests, and I'm happy for you to not answer it. Because when I was in the banking system and I've gone digging, and I understand fiat currency and I understand how governments issue bonds to get money, whether it's the Federal Reserve or from external sources, why? You don't have to answer it, but debt is not a real thing, okay? Like the money that is created. I understand debt when you take it from a bank, or somebody's debt is somebody's credit. I understand from that perspective. But why do governments have to take debt and not just issue the greenback like they did back in the days?
Because that obligation is real. It's just faced by the unborn. Um, what you're doing when you issue greenbacks is you're devaluing the currency. You're devaluing what is at once in a political system a store of value and a medium of exchange.
Yes.
If it continues as a medium of exchange, but you destroy it as a store of value, what you do is you subsidize yourself at the expense of your children and your grandchildren. In the United States, in the period 1913, the time of the establishment of the Federal Reserve, and today, the US dollar has lost 90%, 97%, pardon me, of its purchasing power. That is to say that this monetary system that you describe, while it has occurred concurrently with the establishment of the greatest economy on earth, something it had very little to do with, the purchasing power of the US dollar has declined by 97%. I believe that the 3% that's left will fall by 75% in the next 10 years. People look at the banking system, and people who look at it from our point of view only see half of it. During periods of expansion, it is true that the banks in effect create money. During a period of contraction, the banks destroy money. It's important to understand the default cycle doesn't merely change ownership of assets. It takes the excess currency that was created, the currency in excess of wealth, and it incinerates it. It's important to know that. And people who look at the impact of the banking system on the economy need to understand that when the economy begins to unwind, that everything that they looked at the banking system to in terms of providing excess liquidity goes into reverse. And while that's cleansing, it's cathartic. It's painful.
I totally agree. And that's the thing, because the credit cycle, obviously banks start pulling in their balance sheets and they obviously lend less as well. But one thing from a New Zealand, Australian perspective, at least Australia, I've noticed quite a lot because I was in corporate banking out there. As soon as the global financial crisis hit, the government comes in and says, oh, first home buyers, oh, we're going to give you a grant. Or you want to borrow, we'll give you up to about 90% loan to value ratios. And every time the housing market in one of these countries seems to be pulling back, the government either gets in and tap shoulder to the banks and says, hey, go out and lend some more money. Whereas at least in the US, we had a bit of a cleansing during the global financial crisis.
It was possible to do that. Well, I guess it's still it's possible to do it as long as the fraud continues. As you stated yourself, in 1980, the aggregate on-balance sheet debt of the United States government was 30 to 33% of GDP. Now it's 120% of GDP. And one wonders how long the credibility of U.S. government credit continues to operate. They'll continue to print money as long as they can get away with it. But I think, as an example, while the Fed is pushing very hard on short-term interest rates, the long-term interest rates are rising.
Yes.
That would suggest that private savers are beginning to look at the Fed, not the Fed, look at the whole U.S. government system and say, you know what, this arithmetic's fraudulent. I think the market is beginning to reassert control over the long bond, and that has real consequences.
And I think, sorry, that was one of the reasons why, and this is my observation on this, was the long-term interest rate were actually going up, even though the Federal Reserve was dropping interest rates. And that is when even Janet Yellen and even the Treasury head now, I've just lost his name, Bessent, they started issuing bonds towards the short end of the curve. And they then realized we've got a problem here. No one's buying the long end of the curve. So we've got to issue them at the short end of the curve. And that is why I also see stable coins as actually help them get that. Because as you said, they unlock treasuries. But I still think the US Treasury will still be, or the US dollar will still be the last one standing, because that's just my point of view. You still trust, it's still the cleanest dirty shirt.
The United States has, well, for one thing, it has 24% of the world's savings and investment assets. It's a gigantic market. It's also liquid, and it's also transparent. U.S. government accounts, as bad as they are much more transparent than, as an example, Chinese. And as little as foreign countries trust us, and they shouldn't trust us, they seem still to trust us more than they trust each other. I would suggest you're right. I think that for the balance of my life, for the record, I'm a very healthy 72-year-old, that the U.S. dollar will continue as the world's reserve currency. I do believe that our market share will decline. I believe that increasingly, as an example, Chinese bilateral trade will come to be conducted in Yuan. And I believe that central banks will continue to buy gold. And the consequence of that is that, well, 20 years ago, the predominant asset held by central banks on a global basis was U.S. Treasuries. The market share of U.S. Treasuries as a reserve holding will continue to decline.
Yeah, I totally agree. And I think the seminal moment was obviously Russia's 300 odd billion that were frozen, and most central banks went, oops, this could be us someday. And we just don't trust Uncle Sam anymore. That's when the gold buying of the central bank started. But do you think we could actually, obviously, the global economy is kind of breaking up into two, multilateral or bilateral system or whatever you call it. Do you still think there'll be a Western hemisphere-led US dollar-based system? And the BRICS space, I'm not talking about a gold back, because I don't think any government wants to back their currency by gold, because it just stops them from spending money irresponsibly, right? But I think Jim Rickards has mentioned about a gold settlement, and they're building up some walls in certain places like Hong Kong and Singapore and China. Do you think that might be something that is every 3 or 6 months they settle their accounts? It's like a debit and credit, and just they're not doing anything but moving the gold from vault A, from vault China to vault Russia, or something along those lines. Do you think that could be a possibility in the
I think
future?
it'll work for between 12 and 18 months.
Okay.
Then the traditional debtor nations will run out of gold,
Jeez.
and then it won't work. It works as long as the debtor nations are able to sell their own bonds, in other words, counterfeit, and buy gold. When they run out of gold, that system's not going to work.
Because where's the money going to come from to buy the remaining gold? Is that what you're saying? Obviously, because central banks just are getting mouse click money.
I mean, if you're Brazil and you're running a big operating deficit, you're liquid because you have some gold, but you're not solvent. When your liquidity runs out and you're still insolvent, then you have no gold to settle with.
Hi guys, if you're getting value from what I share, please take a second to like this video and hit subscribe. It helps get these ideas in front of more people who need clarity in a noisy world. And if you know someone who would benefit, share it with them. Your support grows this community and keeps me creating content that makes a real difference. Thank you for being part of the journey and keep connecting the dots. But they said, okay, so I totally got exactly what you said in there, because you're going to run out of gold eventually. Your savings account is going to be empty. But they say China and Russia might have more gold than the US. Do you think that's even possible? Like they said, 30,000 plus tons, some people said China could have.
I've been an investor in Russia until I was precluded from that for a very long time. The Russians need cash. They're fighting a war. The Chinese is a very different circumstance. Well, I don't know enough to comment on the Chinese central bank holdings. Mr. Xi doesn't have me on his speed dial. The Chinese government has been encouraging private ownership of gold. And that's a huge change. And the Chinese have a cultural predisposition to gold. Whether or not the Chinese government has or will facilitate their access to their citizens' gold is a different question. But I would suggest that if you looked at the total gold holdings in China, government and private, and juxtapose that with total gold holdings in the U.S., that gold holdings in China, including the citizenry, have eclipsed the U.S. by far. By the way, I suspect if you ran the same test in India and you included silver and gold, I would suggest that Indian holdings of precious metals, particularly if you included that to South Asia, if you reunited India, if you included Bangladesh and Pakistan, the private holdings of precious metals in South Asia are larger than private holdings of precious metals in the U.S.
Yeah, that's a very good point you make there, Rick, about the South Asian countries. Obviously, the amount of gold that's in India, gold and silver that is held by households in countries like India, Pakistan, and even Bangladesh. I'm not sure if you're aware of this, but something I've come across also, Indian government is the first government who's actually said we can use silver as collateral to get loans from banks. And the ratio, I don't know if this is the first in the world, but they've said you can give up to 10 kgs of silver for every 1 kg of gold as collateral for loans. What are your thoughts on that?
I think that's interesting. My own experience in South Asia, which clearly don't compete with yours, is that the level of social trust in South Asia and the taxation on gold and silver transactions and ownership in India means that most of the Indians that I know have transacted in gold and silver in Dubai as opposed to in India. And I think an awful lot of the gold and silver ownership that I know about in India and Pakistan and Bangladesh is informal, which is to say, this isn't cash or savings, it's part of the formal system. I remember 15 years ago holding a very small session with some young Indian technology-based expats in Sunnyvale, California, asking them how they came to me. And they said, interest in gold and silver. And I said, well, where does this come from? And they said, well, it's cultural. One of these young women said to me, you have very recent experience with the excesses of government, but Indians have experienced this for 1,000 years. The consequence of that is that the institutions around formalized gold and silver ownership and collateral in the Indian subcontinent are fairly new because of the very low level of social trust and the very low level of trust that South Asian people have for their governments. In that sense, they're much more, I would suggest, sophisticated than Western people are. The only real experience I have with Indian participation in formal gold and silver markets is in Dubai. Anyone who goes to the gold souk, in Dubai, will notice not very many Arab faces and not very many Caucasian faces. but they will notice every second week when the paychecks come out for the Indian diaspora, a sea of thousands and thousands and thousands of Indians, Bangladeshis, and Pakistanis, and some Sri Lankans, turning their reals into gold and silver.
Way of saving, a way of saving. And it's, you said the Asian community in Dubai, but as I've said also, there's a lot of people living in South American countries who have benefited, like countries like Venezuela, where I've heard people just use small grams of gold and silver to buy food because they know their governments are not to be trusted and they've seen hyperinflation before, right? So it is a sort of value. So let's go into this conversation. The reason I brought that up because silver is something that nobody talks about. Obviously, central banks have been buying gold, and obviously Basel also made gold a tier one asset a few years back, but then they kind of tried to bury it behind the scenes. So they've allowed banks to use gold as collateral on their balance sheets. And I thought it would be great to get your views on it. If this is the first country in the world is kind of saying, hey, we can use silver as collateral. And I was quite surprised I said the ratio of 10:1, which just drew me kind of going, why wouldn't I just be buying silver and using that as collateral as far as in India? So any thoughts on the tier one asset status of gold at all? Or why is that not being brought to prominence for the average person?
I think the increasing utilization of gold by central banks as a medium of exchange means that gold status as a tier one asset for both public and private transactions in banking is secured. I think that gold's role will grow. I think that the probability of more transactions among BRICS countries outside the US dollar necessitates gold being a tier one asset. The Chinese, as an example, wouldn't want to have $100 billion worth of rubles. They might accept payment in rubles, but I think they would like, for at least as long as Russia has gold, to change those rubles for gold at the earliest possible convenience. I understand them wanting to keep the mechanism of the transaction out of the US dollar to avoid involving the US government. The Russians have indicated an interest in having the Russian central bank diversify their metals holdings to include silver. And I think one challenge for that will be the cash short nature of the Russian economy and the fact that at present, silver doesn't have tier one status. And silver currently probably exposes people to too much volatility to be useful as a 90-day medium of exchange. 90-day medium of exchange, meaning to the extent that there was a transaction, as an example, between India and China that settled in rupiah, the Chinese would need first to receive the rupiah and then to sell that rupiah and buy metals. And it would be difficult in a really volatile commodity, not that gold hasn't been volatile the last 12 months, to understand at the beginning of a transaction how much gold you would end up at the end of that transaction. So it seems to me unlikely that silver will ascend to tier one status. In terms of private mechanisms for silver, there is a very, very, very well-developed leasing market in silver now, where various entities make available silver-backed credit facilities to jewelers, among others. And there are formal credit structures in the United States in very large scale. JP Morgan, as an example, would be highly likely to extend credit against a large amount of silver, probably a $10 million minimum. What doesn't exist in the U.S. Until right now with Battle Bank is the ability for normal living, breathing human beings to access credits secured by silver. That will be available in the market through Battle Bank as early as this coming January. Initially in collateralized amounts over $100,000, but as the market and the technology evolves, Battle Bank's hope would be to develop credit products for investors with collateral as small as $10,000. I think that'll go a long way in the United States and Canada to allowing credit products in silver to mature. I haven't seen a similar level of trust in India around commercial exchanges between Indians or between Indians and their bank, or certainly between Indians that would prefer not to be taxpayers and their government. Perhaps you have more experience than I. I remember being told by some Gujarati friends and clients of mine that they really wanted to do business with me, but it would be impossible for me to navigate India. And that perhaps it would be preferable if the business that we did was structured in Dubai. So I'll leave to you the evolution of metals markets in India, given the low level of social trust evidence there.
No, I totally agree with you. I think about a couple of years back when I came to India for a brief holiday, I looked into metal storage facilities for high net worth individuals just to take away geographic risk. And yeah, the politics is bad in India and the social trust, as you said as well. But I know when I travel sometimes and I'm watching a cricket game, you have Bollywood stars come on television and have advertisements for people to take loans against their gold, at least not the silver. But this one I just read because it was the actual Reserve Bank of India who said it would go live from April 2026. So I just thought I'll get your thoughts on it.
I just hope it happens. I think it would be good for India and Indians. And I think it would be great if more of the transactional value was captured in India. Wouldn't be so good for Dubai, but that's not India's concern.
No, no. I think Dubai and Singapore are the two places that are seen as storage for metals, and especially people who don't want the government knowing where the savings are, what they're doing with their money. That's a very good place. In fact, Indians buy a lot of property in Dubai as well, I've heard. I've heard because I have clients globally, so I understand what goes on in different geographies and all that kind of stuff. The topic of silver, we'll tackle silver first. There's some commentators out there talking that maybe there's a silver shortage, and I've heard you say that is not the case. Do you care to explain, Rick, please?
Yeah, and that requires some explaining. In terms of retail denominated silver, at least the United States and Canada, the dealers are pretty much empty. 1 ounce, 100 gram, that stuff is in really short supply. And those dealers who have access to it are charging often a substantial premium to spot. In wholesale quantities, there is still silver available. I checked with my former employer, Sprott, where I'm no longer an employee, but I'm still, I believe, the largest shareholder, about their access to silver to support inflows into the Sprott Physical Silver Trust. And they said at present, there is adequate supply of wholesale silver. The silver leasing rates, you'll recall, 3 weeks ago went crazy, as much as 40% per annum. That was because there was a 4% differential between the spot price of silver in London and the spot price of silver in New York, Chicago, or Toronto. And rather than leasing silver to American dealers or jewelers or whatever, the holders of physical silver were simply putting it on a plane and flying it from Chicago to London and making an overnight 3 or 4%. That circumstance has begun to ameliorate, and it could be exacerbated quickly if there was a renewed flow of investor interest into silver. But I want to stress that, at least from the information I've been able to gather, that the bullion banks in North America are able to access reasonable quantities of large denomination, large weight, good delivery silver. Sprott certainly hasn't had any difficulty. If the silver market stays in the balance that exists today, not the balance that existed 4 weeks ago, but the balance that exists today, it's likely that much of the non-good delivery silver in the world will be tested, if necessary, re-refined, and entered into the system, which is to say good delivery silver. If silver demand is exacerbated, if the demand levels, institutional demand levels, rise to the extent that they were 4 weeks ago, it may be that the stresses in the futures market will overwhelm good delivery availability. It's common knowledge that if you look at the amount of in-system silver available for good delivery, not just in London, but also in New York and Chicago, that the futures markets often trade 200 times the amount of inventory available for good delivery per day. Now, the vast majorities of these things cash settle. What we saw 4 or 5 weeks ago, 3 weeks ago, for people who were lucky enough to have early expiring contracts, is that people who took good delivery in Chicago could put it on a plane, send that silver to London, and make 4% overnight, which is, it's pretty attractive. And that did, let's just say it caused some ripples in the North American silver market, not anywhere near the ripples that existed in the London market, which was basically empty.
Yeah, so you're saying there's an arbitrage opportunity between the CME and the LME, and obviously that's what's happened. So obviously it was being flown from the US to the London. The London was also empty, even in, I don't know if you noticed, but after Trump got elected, there was supposedly a lot of gold that was flown into the USA as well. And some people are saying that was maybe because Fort Knox doesn't have the gold, but from what I hear and from my sources, it was more to do with European big money moving their gold across to the US. Any thoughts on that?
People were afraid in the U.S. that Trump, in his wisdom, would put tariffs on gold and silver. And there were a lot of folks who decided that if they preferred to hold gold in the United States rather than Europe, that the time to do it was then. And there were, in fact, massive flows of precious metals from Europe to the U.S., to the extent that, and it was fairly unexpected, the Europeans, for a time, or at least in London, ran out of good delivery gold and silver. And the ability of the Swiss refiners to take non-good delivery silver and refine it with a hallmark to introduce it into the system, it's just that this circumstance happened so quickly that the ability to transfer non-good delivery material to good delivery material was overwhelmed by near-term demand. If we assume for a second, and I'm not going to ask you to assume it, but if you assumed for a minute that demand for physical silver maintained at the levels that exist today, as opposed to the levels that existed 4 weeks ago, likely there is enough inventory in North America to allow the European markets to function until more supplies of non-system silver are introduced into the system. It's a time lag. There's a lot of silver out there, but it's not good delivery silver. It's not in system, and it needs to be introduced to this.
Yeah. I also heard at some stage there were some silver mining CEOs in South America who were saying at this price, we just won't bring the silver to market. Even the Dory wasn't being brought in, but we'll put that aside. I just want to ask you now, obviously, we've seen what's happened with gold and silver. Obviously, they've been making new highs, and in the last week or two, we've had some pullbacks. Take this where you need to. Where do you see the price going in the next 2, 3, 5 years? And do you see this is a short-term correction, or there's something more afoot?
Well, let's start with the headline. I do see it as a short-term correction. And I think there will be more short-term corrections. I've been in these markets for 50 years. And in American parlance, gold and silver markets are rodeos. If you can't take turbulence, if you can't take volatility, get off the bull, right? Early in my career, Farzin, the first bull market I was involved in was 1970 to 1980, actually 1981, 10 or 11-year market. The gold price cleared from $35 to $850. The silver price was more extreme, from $1.20 to $50. Okay. I mean, truly an amazing bull market. In the middle of that bull market, 1975, over 9 months, the gold price declined by half. By half. A whole bunch of people that had been committed gold bugs because of the move from $35 to 200 became very uncommitted when the price fell from 200 to 100. By getting shaken out by that volatility, they missed a market that moved from 100 to 850 in 5 years. The lesson is, if you are unnerved by the volatility that you just saw, do something else. There will be more volatility. There'll be lots of volatility, and it will get worse or better, depending on your point of view. If you have the psychological and financial stability to use volatility as a tool, rather than to be shaken out by it, volatility is good. What it means is that there's a series of sales. It's very interesting to me. I was on an interview a couple days ago, and somebody was talking about the decline in gold, and I had to say, which decline are you referring? In 2 years, the gold price goes from $2,000 to 4,200 or something, and then it declines to 4,000. So you tell me, did gold fall by $200 an ounce, or did it increase by $2,000 an ounce? And whether or not you are able to participate in the gold market for the next 10 years depends very much on your answer to that question.
I tell my listeners of all the time, do not think of gold in US dollars or New Zealand dollars or anything like that at all, because it's not that the gold's going up. An ounce of gold is an ounce of gold is an ounce of gold. It's the dollar that's depreciating, and the US dollar has depreciated less than other currencies, and that's why we can see what's been happening around the world. But the human brain just takes everything into account in the US dollar. So if we were to do that, where do you think the gold price goes in the next 5, by the time the cycle plays out?
I think that the nominal price of gold, which is to say the US dollar price of gold, increases in a way that mirrors the deteriorating purchasing power of the US dollar. If, as we talked earlier in this interview, the purchasing power of the US dollar over 10 years declines by 75%, I would suggest that that will be mirrored by the gold price. I need to tell you, I've watched gold markets for 50 years, and I have never seen a gold price forecaster who was accurate. So I want your listeners to hear me say, it wouldn't surprise me to see the US dollar quote on gold 3 times higher than it is today in 10 years, or 4 times higher than it is today in 10 years. I have found that price targets make extremely good headlines, and they're too variable to be worthwhile. So I would just ask your listeners to consider the fact that it's more likely than not that the nominal price of gold, the US dollar gold quote, mirrors the decline in the purchasing power of the US dollar. That means I won't give them a headline, but I'll tell them in nominal terms, not merely higher, but much higher.
Yeah, I really appreciate that. And it wasn't, I wasn't trying to take you purposely down that path, but I tell my clients, and I've said it on the radio or where I get interviewed quite a few times as well. You want to count your gold either, if you're looking commodities, gold to oil ratio, gold to silver ratio, or gold to housing ratio. How many ounces of gold is it going to take you to buy a house as compared to the paper? Because the paper is this, well, I call it toilet paper openly when I get interviewed. It's just a piece of paper which has 100 written on it with the different central banks logos and all that rubbish, right? So my audience totally understands that. And this is as you just said, if the dollar depreciates by 75%, it's common sense the inverse ratio. Gold could go up 3 or 4 times. And again, that also could depend on so many other factors where if you go to war or if you go to hyperinflation, it could go even a lot more upwards or whatever it is. Talking about the hyperinflation, I just want to get your thoughts on, obviously, I've interviewed a few people in the US already. I get a view that there is a bit of stagflation. People are losing jobs. There's a recessionary feel that we already spoke about. But if I was to ask you, because I think there's a short-term deflation just for a few months, for maybe 6 to 12 months coming after we go into inflation, hyperinflation. What is your view on, are we going into deflation or higher inflation?
Well, for savers, for people like me, deflation is a very good thing. It increases the value of money, something that we have. And I think technology is deflationary. The ability to substitute capital for labor, which allows you to pay fewer workers more, is deflationary. And deflation is actually very healthy, unless you are one of the workers who doesn't have enough skill sets to employ capital, and rather than employ capital, you become unemployed. I certainly agree that there are underlying deflationary trends in the U.S., and a default would be extremely deflationary. That would really, really be deflationary. The policy response to inflation in the U.S. will almost certainly be even lower, artificially lower interest rates, and quantitative easing. Quantitative easing being government speak for counterfeiting. So the policy loss to the threat of deflation is extremely inflationary. It's important to understand that. Deflation benefits savers. Inflation can benefit spenders. In most democracies, there's more spenders than savers. That's so. Policies that allow people that don't have any savings to compete with those who do are extremely popular, and they're inflationary.
And the whole point is everyone's in debt, right? So the person who's in debt could very well get wiped out, and it might be really difficult for them to pay the loans. So obviously, what do politicians and central banks do? They create more money because they've got to please 90% run too much debt rather than do the right thing. Hey, do you have any view, just a 1 minute view on Bitcoin at all? Because I've never heard Rick.
I don't. I understand conventional financial services, and I understand natural resources. And so I confine my thinking to the two topics I understand, and I avoid, like the plague, those topics which I don't understand. And that includes Bitcoin.
Rick, thanks. You've been gracious with your time. Just do some fun questions now where people get to know Rick. What books do you recommend to your friends or family most often?
That's a deep topic. I read a book a week.
Most wealthy people do. Yes.
I'm an addict. Let's ask the question differently. There are 4 books that I ask parents to buy their children to explain the way the financial world works. I ask them to start with Economics in One Lesson by Hazlitt, which teaches youngsters the way the economy works rather than the way the big thinkers wish you believed it worked. It's easy to read. It's a wonderful book. Economics in One Lesson by Hazlitt, available through Amazon. It's quite cheap. Once you've read that, so you understand the way the world works, the best investment book ever written relative to the effort required to read it is The Intelligent Investor by Ben Graham, partially because it's easy to read. So after you've read Economics in One Lesson, read The Intelligent Investor by Ben Graham. If that book was interesting to you, then buy the best investment book ever written, which is Securities Analysis, also by Ben Graham. This book is not easy to read. This book is a very good cure for insomnia. But it simply is a book that if you read it and you employ the lessons taught in it, you will become rich. Not you might, you will. It's important that you don't just buy it. You have to read it, and then you have to employ the disciplines in that book. But if you do those 3 things, you will become rich over time. The fourth book is a very hard book. It's called Human Action by von Mises. It tells you why the third book works. It talks about human nature, human action, volition. It was written in very turgid German and translated into even more turgid English. It is the most impactful book I've ever read. People get angry when I say that. They say that should be the Bible, but the truth is what it is. The most impactful book I've ever read, the one that changed my life and my ability to interact with society the best, was Human Action by von Mises. So those are the four books I'd start with.
Fair enough. Thank you for that. I generally just ask for these recommendations, and then I put the links in the show notes for the audience. And what strategy do you recommend people for building long-term wealth, right? Everyone wants the next quick buck, long-term wealth.
Well, first of all, think long-term. Often I talk to investors who have reasonable strategies. They say that they think X will do well over 5 years, but their tactics are that they have trouble holding stock over a long weekend. If you juxtapose a 5-year theory with a 3-month practical outlook, you're doomed to failure. What you say is very true. Everybody wants immediate gratification. The consequence of that is immediate gratification is almost never on offer. People think that what they want is somehow relevant, which is very amusing as far as I'm concerned. You need to focus not on what is relevant, but rather what you can have. And until you adopt that sort of realistic viewpoint, you are going to be poor. I believe, as an example, that the best investment that one can make in the natural resource business right now is in oil and gas. It's out of favor. It wouldn't surprise me to see the oil and gas quotes go lower before they go higher. But I believe that the big picture paradigm, which is to say that peak oil demand occurs 5 years from now, is wrong. I think it occurs 35 or 40 years from now. And that means that the market is undervaluing oil and gas assets by at least half. But I'm thinking in a 5-year term. That investment may well do nothing for you in 3 months or 6 months, or it may go down before it goes up. But when I look at the value proposition in oil and gas, you're buying assets at 50 cents on the dollar, where the net present value of those assets, which is to say the dollar, doubles or triples in 5 years. But I'm thinking in a 5-year term. When people say to me, I don't think I want to do that. I think I want to buy Bitcoin because Bitcoin's gone from $1 to $100,000. I need to say, what is it about Bitcoin that makes you think, hey, it's worth $100,000? I don't know. I don't care. But what
The
it seems to
greater
me,
fool theory, somebody else has to buy it off your hands, right?
yeah, I mean, it seems to me that the Bitcoin narrative has validity to people because of the price action. But it might be, I'm not saying it is, but it might be that the price action has already fully priced the theory. And so I would tell people that the single most important, well, there's two things that people have to do. The first is they have to work. People would prefer to feel than think because it's easy. People pay all kinds of attention to the price of an asset or the price of an equity without having any sense of the value, because the value is subjective and it's hard to get. Price information is of no use whatsoever if you don't have an opinion of value that you can juxtapose that price action over. And the most important component of investing, the most important, is compounding and the time value of money. If you ignore compounding, you give up your single best ally. So Warren Buffett says he made his fortune by doing a lot of thinking, or pardon me, a little thinking and a lot of waiting. He and Munger once said, and I read this, I didn't hear it, that their best investments required of them sloth and lethargy because they had both of those in abundance. And if an investment like See's Candy merely involved waiting for 30 years and being willing to cash checks every month for 30 years, that's the kind of investment that they preferred. Many investors' eyes glaze over at the thought of a 30-year hold. I've come to cherish them.
Yeah. I think you also have to have, you make such a good point there, Rick. I think when we were talking about the gold and stuff as well, you've got to have a basic view or a macro thesis of what's going to play out over the next 5 or 10 years for you to then see how it is. As you said, gold, oil and other commodities. Obviously, with the green agenda and what the governments have been doing around the world, which obviously now is moving around, there will be shortages in oil and gas. So you're completely right. There are commodities which are going to, obviously, because people need it, they're not going to give up driving their cars tomorrow. That's going to go up in value. But there's a quote that I've heard you once say, and I thought that was so brilliant, because you said, I wanted to buy a Mercedes and the Mercedes went on sale, am I buying more of? Am I going to go out and buy it if it's half the price? Am I going to? And this is where the macro thesis comes in for gold, because I think people panic because they're just buying gold because everyone else is, because the price is going out, or if they missed out on Bitcoin, they want to buy gold. But if the price goes down, people like you and I are actually going and buying more because we understand the macro thesis behind the debasement trade or what governments are going to do, right?
I would be even more aggressive. I say that you buy gold as insurance. This is going to sound very odd to people. You buy it with that proportion of your wealth that you think is necessary to maintain your purchasing power, and you pray it goes down in price. You pray. I honestly pray that whenever I shed my mortal coil, that my investment in gold proved to be unnecessary, that I didn't have to live through the set of circumstances that would cause that gold to become invaluable to me. That's a pretty strong degree of faith. If you are willing to allocate a substantial amount of money to an asset class that you hope declines in price, that's the fondest thing I can possibly say about gold. Unfortunately, I don't know what the price of gold will be in the future, but I suspect my gold will come in handy. I wish it didn't.
And yeah, because if it goes up by too much, the world's falling apart. But the whole point is also this asset allocation. So maybe when it goes to a certain stage, you hold on to some basic, some of that could be then converted into a house or other assets that are underpriced. I know you have brilliant quotes and advice, but the best advice you have received from someone.
Your primary asset is yourself. Invest in your education and your intellect, and invest in your reputation. If you destroy your reputation, your ability to employ capital, to attract capital, to deploy capital becomes nil. So be the very best version of yourself that you can. Make people eager to do business with you because they may not know what specific value that you yield, but they know that you will yield value. And then invest in your intellect so that people who are attracted to you by your reputation can derive benefit from your intellect and pay you for that.
Very, very well said. And the last question that I ask every guest, obviously I've got a financial consultancy that's called Success Simplified.
I think you've frozen.
So Rick, how do you define success? Hi guys, unfortunately at the end we had to drop off because of technical difficulties. Rick Rule could not answer the question, what does he see or define success as? So the next time we have Rick Rule on our show, I'll be definitely asking him that question. How does he define success? In the meantime, I'd like to let people know where they can reach out to Rick Rule. There's a couple of places that you can. ruleinvestmentmedia.com. This is where Rick shares his wisdom and his knowledge of 50 years to help people with commodities and natural resources and understanding how things work out. And the other place you can also reach out is Battle Bank. He's the co-founder of Battle Bank. As you can see the heading here, it says Battling for Better Banking. So they're trying to bring a better banking experience to the average person. Obviously, right now it's only in the US. So it's paddlebank.com and Rule Investment Media are the two places where you can reach him. And I'd just like to tell our audience, please do like, share, and subscribe because it helps with the algorithms. And obviously the knowledge that we're sharing on this channel is to be shared with other people so they can be better prepared for what's coming. So please do like, share, and subscribe. Until next time, can keep connecting the dots. Thank you very much for watching.